Tyre Industries Limited Q3FY22 Earnings Conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be no opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Basudev Banerjee, Vice President at ICICI Securities Limited. Thank you, and over to you, sir.
Thanks, Lizanne. Good morning to everyone. Thanks to everyone for joining the call, and thanks to JK Tyre's management for letting us host this call. I'd like to introduce the JK Tyre management. We have with us Mr. Anshuman Singhania, Managing Director of JK Tyre, Mr. Arun Bajoria, Director and President of JK Tyre, Mr. Sanjeev Agarwal, Chief Financial Officer, and Mr. A.K. Kindra, Financial Advisor. I'd like to hand over the call to Mr. Anshuman Singhania for his initial comments, and then I will take on with the Q&A. Thanks. Over to you, sir.
Thank you. Good morning to everyone and a warm welcome to JK Tyre Q3FY22 earnings call, and thank you very much for joining us today. I am Anshuman Singhania, the Managing Director. With me, Mr. Arun Bajoria, Director, President, International Operations, Mr. A.K. Kindra, Financial Advisor, and Mr. Sanjeev Agarwal, CFO of the company. I wish you all a very happy New Year 22. The year 21 ended on a positive note of recording highest ever quarterly sales by JK Tyre, crossing 3,000 crores mark for the first time. This has been achieved along with the highest ever export of rupees 484 crores for the quarter 3 FY22, taking the total export to 1,414 crores during the 9 months, which is up by 75% on a year-to-year basis. We are the largest exporter of on-highway tires to USA. Going forward, in the line with our strategy to gain higher volumes, we will continue to expand our presence in the technologically demanding markets like Europe, North America, with market-specific products like truck and bus and passenger car tires. Domestic market continues with the strong momentum of good demand for TBR, LCV radial and HCV radial tires in the CV segment. OEM registered a high single digit in CV segment. However, the non-availability of semiconductor chips and logistics disruption continued to impact the PV demand, which in turn affected PCR tire demand from OEM during the quarter. Further, the farm segment sales in this quarter is impacted due to high base of last year and delay of very heavy rainfall in various geographies. The industry expects momentum to recover in the coming months on account of the good progress of Kharif crop procurement. This will bring liquidity in the hands of farmers. We are optimistic on the outlook of car industry and believe there will be a good growth demand across all market segments given the expected economic activity going forward and waning off of the pandemic. Further, we expect robust demand in the domestic market with boost in economic activity emerging from a strong infrastructural spending by the government, including multi-mode connectivity initiatives and government agriculture productivity improvement initiatives through technological and digital advancements announced in the budget. This will lead to increase in rural demand and improve in overall market conditions and consumer sentiments. JK Tornel has also contributed significantly to the highest ever revenue during the quarter on the back of good demand in American markets. On the financial front, JK Tyre registered a growth of 11% in the top line over the corresponding quarter, which stood at 3,084 crores. The industry continued to witness an unprecedented increase in input costs, which has impacted the operating margins. The unabated increase in the input cost has been partially offset by some price increases. We intend to increase our selling price again to neutralize the impact further. Parallelly, we are also taking rigorous measures to improve the overall operational efficiency to improve margins. Energy conservation as a drive is the core to our value system for moving towards the green manufacturing. On the renewable energy front, we have achieved excellent milestones in terms of our power mix, which stands at 55% through renewable sources. We will continue to increase our share of renewable energy. Our efforts on thermal front have also yielded good results, and we have replaced over 18% of the coal by biomass, which is substantial, and it is a significant step towards green energy. I am happy to announce that recently JK Tyre has received the CII Active Customer Engagement Award 2021. This is a matter of great pride and shows that we are on the right path towards our mission to be customer-obsessed company, customer first, 24/7. Further, we have achieved very encouraging feats in our businesses. 3 of our units, which have now rated 5-star for the Globe of Honor awarded by the British Safety Council. This is on the top of last year's award of Sword of Honor given to all our units. ET Iconic Brand Award 2021, second time by Economic Times. Brand of the Decade 2021 by Brand Advertising Research and Consulting Asia and Herald Global. Golden Feather Award for the Best Digital Marketing Campaign, Zindagi Ke Pahiye, and the Best Brand Campaign for the Ranger series. JK Tyre has been recertified as a great place to work and also featured as India's best workplace in the auto and auto component industry category for the year 2021. Most importantly, the company has achieved vaccination level of almost 100% of its employees for both doses during the COVID third wave. JK Tyre has placed the highest emphasis on safety and well-being of the employees, business partners and society for continuing of the business as well as livelihood. Now I would request Bajoria ji to talk about the performance of JK Tyre and subsidiary companies.
Thank you very much, Anshuman ji, for this brief highlights and the performance of third quarter of financial year 2022. Now, with regards to the JK Tyre subsidiaries performance, both the subsidiaries continue to contribute well in terms of overall revenues and profitability. Cavendish Industries Limited recorded net revenues of rupees 720 crores in Q3 financial year 22 as compared to 788 crores in Q3 of financial year 21 corresponding quarter. EBITDA stood at rupees 32 crores in Q3 and we are happy to share that CIL, that is Cavendish, got approval from Mrs. Ashok Leyland for regular supply of TBB, TBR and LCV bias tires, tubes and flaps, in addition to the other OEM approvals which CIL was able to get last year. JK Tornel, Mexico, has performed well and has achieved over 100% revenue growth from rupees 727 crores in 2020 to rupees 1534 crores in 2021 during the first 9 months of the fiscal. During the quarter, JK Tornel achieved a turnover of 521 crores as compared to rupees 364 crores, which is an increase of 43%. Further, EBITDA was recorded at rupees 46 crores, which is an increase of 7% on year-on-year basis. Despite increased raw material costs, the profitability margins at JK Tornel have improved by 560 points BPS during the 9 months period ending 31st December 2021, mainly due to price increases. Profit before tax stood at rupees 34 crores and profit after tax stood at rupees 19 crores in Q3. JK Tornel increased its market share in passenger radial from 7% to over 10% in this fiercely competitive market comprising of international players in the tire industry. Also, JK Tornel has highest market share in mass merchandising sales like Walmart, Chedraui, etc. Taking advantage of higher customs duty on Chinese and other Asian tires, JK Tornel penetrated into USA successfully in the first year itself. JK Tornel continued to record highest online sales in Mexico using social platforms Facebook, Instagram. The brand salience of both Tornel and JK Tyre was at its highest by way of tunnel advertising, radio campaigns, including participation in Latin countries, Colombia, Brazil, and others. Now, I would request my colleague, Mr. Agarwal, to brief about the financial performance of this quarter.
Thank you, sir. Let me highlight the performance of Q3 FY22. The consolidated sales were recorded at rupees 3,084 crore as compared to rupees 2,776 crore in the corresponding quarter, registering an increase of 11% on YOY basis. The capacity utilization was around 89% during the quarter. All the market segments contributed to the above revenue growth. Exports revenues were recorded at 484 crore vis-a-vis rupees 332 crore in Q3 last year, an increase of 46%. In the 9 months of financial year 22, our exports have grown by approximately 75% over the corresponding period, that is from rupees 808 crore last year to rupees 1,414 crore this year. Profitability at EBITDA level was recorded at 281 crore on consolidated basis. EBITDA margins stood at 9.1% as already discussed. The profit margins contracted due to unprecedented rising input costs. Cash profit stood at 177 crore and profit after tax stood at rupees 54 crore. Finance cost is in line in the 9 months period of FY22 has reduced by 12% from rupees 361 crore to rupees 318 crore, reduction of 43 crore on Y-on-Y basis. Additionally, we are following strict credit discipline and efficient cash management with lower borrowing costs. The leverage ratios of the company remains at comfortable level. we have been continuously focusing on deleveraging. We have reduced long-term loans of rupees 475 crore during the 9 months period in the current fiscal. Our long-term debt is estimated to reduce by 1,400 crore, which is about 45% in next 3 years by the year 2025, from the present level of rupees 3,200 crore. We have already circulated our earnings presentation, which is available on our website as well on the stock exchange website. Now we are open for the question and answer, and would request if one can ask questions one by one, please. Thank you.
Thank you. Ladies and gentlemen, we will now begin with the question and answer session. Anyone wishing to ask a question may please press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is on the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Yeah, hi. Firstly, what is the net debt level as of December?
So net debt level as of now is about 4,800 crore, including the working capital, which is at about 1,850 crore.
1,850 crores?
Yeah, that's it.
And we mentioned that overall utilization level is 89%. What is the utilization level in the Cavendish during the quarter?
So overall it is 89%, and for Cavendish Industries it is about 82%. And this is now presently, although this has gone up to about 90% plus again, but for the last quarter it was slightly lower.
So if I look at Cavendish, and which is probably the lowest cost tire from our side in the market in TVR, despite the low pricing, we have seen a big drop in volumes. I think last year, this quarter, we were operating around 95% utilization level, and now we are down to 82%. So can we highlight what is happening? Because I think because of the pricing pressure in the market in terms of inflation and everything, cost going up, I think I would assume that a fleet operator will prefer a low-cost tire, but in our case, we are seeing a fall in Cavendish utilization level. So can you explain why this is happening?
No, I'll tell Bajuri to take this, please. Thank you very much. No, you see, first of all, I must tell you that there is no low-price tire from CIL as such. But yes, we do manufacture some Tier 2 tires to compete with the Tier 2 tires of our other competitors. That is one clarity that I want you to have. Secondly, the production was certainly affected in the month of September to some extent, and in the month of October to a little extent. We had some labor disturbance in the 2-3-wheeler section, and therefore some effect of the overall tonnage, and therefore the effect of some low sales, but not more than that. Thank you.
So you mean to say that there is no demand issue for Cavendish? This is only a production issue in two-wheeler and two-wheeler tires in September, October. I guess that
to the extent, I must again clarify that the OEMs have not been very bullish, and they were working at almost about, let's say, 50-60% during these last 3 quarters, and now in the 4th quarter we are seeing some movement. And because of the sluggishness of the OEMs, we obviously got affected at CIL also, and particularly in the 2-3-wheeler tires, which were to be supplied from there for replacement as well as for the OEMs.
how do we see replacement demand, especially in the truck segment, truck radial segment, in this quarter, like January, February, versus the third quarter, November, December, that period?
So we are very bullish about the demand going forward. We are very optimistic on the outlook of the tire industry, and we believe there will be a good demand growth across all the segments. And given the expected economic activities going forward and the COVID waning off, further, we expect that robust demand in the domestic market with boost in economic activity emerging from strong infrastructure spend by the government, including multi-mode connectivity initiatives, the government's agriculture productivity improvement initiatives. So all this will definitely give a boost to the rural demand and improve the overall market conditions and consumer sentiments. In the export market, anti-dumping duty on China products in USA and other markets continue. So this will also give a boost to the Indian tire industry.
And my question was more specific to, like, say, are we seeing improvement in January, Feb already, or this is expectation that in future demand will improve?
Yes, we are seeing an improvement in January, February, and certainly March onwards. Things should improve. So
one more thing I would like to clarify, that as we have also seen in the third quarter, our revenues have grown by almost about 11%, right? And it's only because of the pressures on the margins, because of the input cost inflation, the margins were lower. Otherwise, I think the demand is continuing, and the demand will continue. We see a very good demand growth in the fourth quarter. And as Anshumanji said just now rightly, there is a very good emphasis on the infra and other things. So in the near term, yes, the demand growth is there and in a good at a good level, maybe in mid-teens level. And going forward also, this is likely to continue for next few years. So this is about.
So on the sales growth front, I think versus last year, the prices are up by almost 10-11% versus the order last year. I think the entire growth that you're talking about is probably a large chunk would have come from just this price increase, and also we have done very well in exports. So I think Triumph AC, it looks like that probably volumes in the domestic market would have declined YoY. It's growth driven by pricing plus exports for us. And that is true for everyone.
I was talking about the overall company on a consolidated basis, whether it is coming in from the export market or from the domestic market. So the things are looking very good. And particularly in the domestic market, this was my view. But you're right, there is some impact of the increase in prices also. But the increase in prices in the last quarter is only about, let's say, 2 to 3% approximately, to offset for the price hike on the raw material side. And this is the way actually the position is looking like. But the outlook is quite positive. Oh. And this we have been, of course, saying for the last several quarters also, and we have been seeing, because we have also taken the benefit of the pent-up demand earlier after the pandemic. And going forward also, we see that because of various initiatives by the government and the economic activities picking up, as Anshumanji explained, things are looking good as we can see.
Okay, sir. Thanks and all the best.
Thank you. The next question is from the line of Bharat Bagnani from Living Root Capital. Please go ahead.
Yeah, hi. I have a couple of questions.
Just a second. May I just suggest that in the first round, please limit your questions to maximum 2, and then you will get another round where you can ask more questions. Thank you.
So that everybody gets an opportunity.
So, given the raw material basket that we have right now, how much more price increases do we need to take to get back to our better operating margins?
Raw material prices has been unabated, Can I answer that? So on the raw material input prices have been really unabated. So this in the last 1 year, the impact of raw material price increase on the selling price has been approximately 23%, which has been partially passed on about 60%. And we see every opportunity to increase our selling price again to neutralize the further impact.
So, Anshuman ji, in the last quarter that we're talking about under review, what was the price increase taken by the company?
So this was approximately 2%.
2%.
Okay. And the second question is that, we had previously as a company said that we would reduce the debt by about 40%, long-term debt by 40% by FY24. That seems to have moved forward by 1 year to FY25, and we've increased it to 45%. So, I mean, are we looking at doing some more expansions, or, I mean, what is the thought process here?
So we will definitely be, as I have also said, actually that in the past that we have been working on the expansion plans, right? And Anshuman ji, I think would like to comment on this too.
So we, as we've been already saying that, the company has been taking up this debottleneck capacity. We've nearly spending 200 crores to unleash the PCR capacity, and plus 100 crores for the our maintenance capex. So, and furthermore, we are taking up an expansion program for TBR capacity at an estimated cost of about 240 crores, which shall be implemented in phases and shall be completed by March 23. This will enhance our capacity by 342 lakh tires per annum.
And this is at CIL?
Yes.
Okay. These were the two questions that I had.
So I will answer the second part of it, one which you asked, because you are right that we will be repaying about 45% of the long-term debt by 2025, right? And there is a let's say addition of 1 year, but also there is a subtraction of 1 year which has already gone. Like 9 months period, during the first 9 months period, we have repaid 475 crore rupees on long-term debt. So we have taken that into account, and that is why we are saying that in the next 3 years period, by end of 2025, we will be repaying almost about 1400 crore rupees of debt, which is working out to be about 45% of the existing outstanding long-term debt of rupees 3,224 crore exactly.
Okay, and Sanjeev, this is taking into account the expansion that you spoke of.
This is on the basis that we have calculated on the basis of the present debt and the repayment schedule. So for the future, the financing is being worked out, the way it will be financed and all those things are being worked out, and we will come back to you next quarter with the exact plan.
Okay. Just an information point. If you can tell me what will be the exit figures for March FY22 for JK Tyre steel wheels, express wheels and truck wheels.
Right.
In these 3 months, what will be the number of additions?
So there we have definitely added our channel partners. So we are roughly around 700 brand shops, which is totaling to 700 brand shops, which is steel wheel, express wheels, farm express, and truck wheels. And addition to that, we have retread centers in the tune of 55, and then we have 6,000 plus dealers in our network.
So any additions that are planned already that are in the pipeline for the next 3 months or next 6 months?
For the expressive ones? Brand shops are you talking about or the dealers?
Yeah.
Because in the last 9 months also, brand shops.
No, we have a continuous plan month on month, and and this is an ongoing process.
Okay. Because we see that some other competitor companies have much higher proportion of brand shops than we have. So we feel that as investors, it adds to the pricing power when we have our own exclusive brand shop available and customers.
So it may hold true or maybe not, depending on each individual's company's policy. But we, as I told you earlier, that we have continuously increasing our own brand shops plus our dealer footprint in terms of expansion.
So we are focusing more on the dealers right now to sort of increase the number of dealers because there's been a good addition of dealers.
Yeah, you are right. In the last 9 months period, we have added almost about 750 dealers. So focus is the appointment of dealers, Nightfall, and also continuously expanding our exclusive shops.
All around outlet. It is because of this expansion of the network that you have seen the enhanced sales for the last 7-8 quarters. A lot has been contributed because of the expansion of the network. Okay. So that has been the key benefit of it.
Yes.
Okay, that's all from my side, and all the best for the coming quarter.
Thank you.
Thank you. The next question is on the line of Jinesh Gandhi from Motilal Oswal Financial Services. Please go ahead.
Hi, sir. Congrats on the reasonable numbers in a challenging quarter. My first question is the volume growth seen during 3Q at the blended level. Hello?
Yes. You see, in terms of our consolidated, we have increased our revenue by 11%. And though there has been a lot of shuts in the OEM, particularly in the October, November, December month, there has been shuts in the OEM in the various categories from truck, passenger, and 2-3-wheeler, and as well as farm. That has definitely impacted a certain part of the volume. And there has also been an impact of volume in the aftermarket, in the domestic, because as you know that there was a COVID as well. So there were a lot of shut and open of the economies in various states. So that has also led to little accumulation of inventory, dealer inventory. But we are very hopeful as now COVID is waning off, the economy is opening up, the core sector has definitely opened up in steel, cement and other commodities. With this, there will be a lot of volume push going forward.
Okay, but would you be able to share the volume growth or decline number for the quarter?
So in terms of, can I answer this? So in fact, in terms of the volumes that we talk about, in the TBR, which is our major revenue contributor, right? So that has grown by high level of high level of single digit, and otherwise there is a slight flattish kind of a level for other segments. So the truck and bus, radial, and the passenger vehicle, of course, that has grown. So others have not grown, because those are the things which are governed by also the 2-wheeler and 3-wheeler and non-truck buyers. So those are not, these are more or less constant.
Okay, got it. And secondly, with respect to the capex, given that we are investing in conscious manner on the growth part,
what will be the cash flow of 22 and 23?
Cash flow.
No, so for the expansion you are talking about?
Yeah, expansion and maintenance both put together, what will be the cash flow impact of CapEx?
So as we have said earlier, that we have been taking up the expansion plans in a gradual manner, and that is why we have announced in the past about 200 crores of the debottlenecking which is undergoing at the moment, and this was spread over the 2 years period of FY22 and 23. And in the case of the expansion plan which Anshumanji just now talked about for the TBR capacities, so total expansion is about 240 crore rupees, which will be implemented again in phases. And we are working out the cash flows, that how much will be required in which period, but the overall project will be implemented over the next 15 to 18 months. So the amount will be out over the next 1.5 years period.
1.5 years. Got it. And lastly, you indicated about the price hike of 2% in 3Q. How much have we announced so far in fourth quarter?
So as we are seeing the situation, we will be, as I told you, that 60% has already been passed. So we will be passing on the rest in this remaining quarter, and to the extent possible.
Okay, but any increase taken?
Yes, there has already been an increase taken. That's why we've been able to cover almost around 60% of the cost of selling price.
Sorry, I meant any increase taken in Genset so far?
Sir, maybe if you don't mind, these are very, very specific operational action plans, and you will kindly appreciate that it may not be fair to ask and also fair on our part to give out everything like this. Please.
Okay, no worries. Thanks.
Thank you. The next question is from the line of Mitul Shah from Reliance Securities. Please go ahead.
Yes, sir. Thank you for taking my question. Sir, anything sizable on inter-segment revenue between CIL and JK?
Yeah, just a minute. Let me just take out that figure if there is any. Yes. So this is not anything material, but yes, as we have been exporting in the American markets, and therefore we have exported through our company JK Tornel. So some amount of exports from JK Tyre and from CIL also, and aggregating to about 240 crore rupees. That is the inter-segment sales.
But in any case, at the consolidated level, this is all netted off, Mr.
Yeah.
Sir, on the India side, basically, I am asking about between CIL and JK. Earlier, we used to send from JK to CIL.
That is very small amount of 100 crore rupees.
Okay. And the second question is on the Mexico side. Sir, can you throw some more light in terms of any further scope for margin improvement due to restructuring, or it is already done, apart from the whatever benefit we'll get from the raw material side in coming quarter? Margin got impacted this time because of the RM side, but anything on the other cost parameter?
Well, yes. You see, we have, as I have just mentioned to you, that there is a growth of already 43% in our Mexico operations in Q3. And overall, as I was mentioning, that we have increased our revenues by 100%. And on the call of your margin improvement, yes, we are taking continuously steps. And for example, we had two plants of bias, and we have merged them into one plant, and therefore the cost of economy as far as merging and therefore the overheads reduction is all taking place. We have also taken some price increase with effect from 1st of February 22. And, these are absolutely ongoing, continuous management exercises to keep seeing how to further improve margins. as and when there is an opportunity.
And sir, lastly, on the export side, it has now become sizable, close to 20% now, and at consolidated level also it is more than 20%. So can you give broader breakup or growth parameters for key 2-3 regions?
Well, our export, as I mentioned, that our export performance is continuously growing, and our achievement export growth has been over 46% on YOY basis, and in 9 months, YOY basis 75% basis, 75% growth. We see that the America has been very robust in terms of growth, which includes Mexico, US and Canada. Then we have even the Middle East and Asian region, which has given us growth, and these are some of the growth areas which export has been able to do well.
So can you give ballpark number for this? How much would be American, how much would be this Middle East and any other major contributing country?
We will divide it into 2 categories only. The American continent is approximately 50%.
50%, and the balance is 50% rest, which includes Europe, which includes Asia, which includes Middle East.
Okay, thank you, sir.
Thank you.
Thank you. The next question is from the line of Rishabh Shah from Anubhuti Advisors LLP. Please go ahead.
Thank you for the opportunity. So my question is what percentage of the sales growth was attributed by the price hike and the raw material cost increase and volume growth? Sorry.
Can you repeat your question, please, once again?
How much percentage of the sales growth was attributed by volume growth and price hike?
So the volume, the price hike in terms of the total volume would be around 60%, and around 40% would be the volume increase.
Okay, sir. Thank you, sir.
Thank you.
Thank you.
The next question is from the line of Shashank Kanodia from ICICI Securities. Please go ahead.
Yeah, thanks for the opportunity. So with this debottlenecking and calibrated expansion that are doing with the TBR segment, what kind of incremental revenues are expected out of this 450 crores of capex?
Yeah, so we can expect the total expansion cost is about 240 crore, and we can expect approximately 500 crore plus kind of revenues from the TBR expansion. And because why I'm saying so is normally the tire industry, the revenue to capital is almost about 1:1, right? But in this case, because we had already incurred capex on long lead items, as you would recall when we had announced the project earlier, so we had incurred and we have already got the equipment which were long lead items. So now with some amount of the expenditure, which is of course adding to taking the benefit of the earlier cost incurred, so this will give us a very good increase in turnover, and that is why we are taking it up in a phased manner. And the total amount of the revenue will go up by almost about 500 crore rupees.
Okay, and so what will be the same figure for debottlenecking exercise, for which we intend to spend 200 crores?
I'm sorry, you are talking about 200 crore rupees of PCR one?
Yes.
So similarly, in the case of PCR also, because this is a debottlenecking and unleashing of capacity, so the turnover to the cost incurred will be much better, and this is not the greenfield expansion or brownfield expansion, this is debottlenecking. So we are expecting this to be also in the range, in the ratio of about 2:1.
Okay, so roughly, sir, 900 to 1,000 crores of incremental revenues we can expect from these expansion plans, right?
Yeah, both the expansion plans.
Both together. So currently we can attain a peak revenues of 13,500 and plus this 900,000 crores, we can do 14,500 kind of peak revenues, right?
No, but I think there is a capacity utilization at the present level of about 90%, no? So because of the 10% capacity which is available and also the expansion which is going to happen, so we can even do more.
So at max 15,000 odd crores is the peak revenues that we can do?
You can assume so.
Okay. Secondly, sir, with the kind of calibrated price hikes that you're doing in the system and the raw material price increase, what is the sustainable margins for us in the Indian operations as well as for the console levels?
See, this all depends upon how much price increase has taken place in the case of raw material, and also because we have also been passing on the increase in prices in a phased manner, in a gradual manner, and this is the phenomena which is prevailing in the industry. So we expect that this margin level is definitely on the lower side at the moment, and we can expect this to be upwards of let's say mid-teens.
Okay. So, sir, in the long-term basis, 11 to 12% should be at least the minimum range of sustainable margins, right?
No, that is what I said. Although nobody can comment on the margin because this is very difficult to predict, but the sustainable margin should be in the range of high teens, I said.
Okay. And at worst case, they should bottom out this quarter because largely I think raw materials have kind of stabilized with the prices.
Nothing can be said as I think Bajori ji is trying to say on this point. So
No. I was just saying that probably you meant that raw material prices have stabilized, but in our actual operations, we are seeing unabated increase. Even now, they are on the rise, maybe on a lower scale, but certainly. But I can only tell you to satisfy you that we are working very hard to improve our margins further, and it should be possible, as you said, 11-12%. Now, exact specifying percentage may not be possible, but certainly we will try to even better these numbers.
Absolutely.
This kind of a raw material price uncertainty, it is very difficult to predict as of now. But as Mr. Bajori has said, we are at it, and every effort is being made to make the best use of the operation.
And further improve the margin.
Things like that. They are also equally important. Maybe Anshumanji will like to say a word on the operational efficiency, the kind of actions they have taken.
Sure. No, in terms of our, we are enhancing our efforts to improve our efficiency in terms of in manufacturing, such as productivity, lower energy, water consumption, and reducing waste, and then plus increase in our digital AI-based tool in our manufacturing and marketing functions. Also reinforcing our sale of premium tires, such as smart tires, and launching premium tires going forward like puncture-proof tires and high-end tires like Levitas. We have recently launched smart tires, which is gaining a lot of volume growth. Plus our mix also we are changing, and we are focusing on premiumization, particularly in the PCR and the TBR segment.
Right. And sir, one last question. In the initial remarks, you alluded to greater exports because of imposition of anti-dumping duty on Chinese tires. So is it a recent phenomena, and since when have these duties been imposed? If you can throw some light about it.
On American markets, Chinese anti-dumping is approximately been about 2 years, and so that has definitely helped rest of the world to cater to America, including India.
Okay, so has in the recent past, are we witnessing like China plus some kind of a sourcing strategy from the American counterparts, which has led to good amount of increase in exports, or any price competitiveness that we have? Anything?
Why not? We are scanning opportunity. We are for sourcing tires for the export. But the most important thing which we follow is the quality consciousness which we have. So we are always evaluating opportunities in that respect.
Sure, sir. Sure. And one last thing to Sanjeev ji. Sir, last year, FY21 ending, our net debt was roughly 45 odd crores, right? And that increased to 4,800 crores as of December 2021. Is it correct?
So actually, you're right. In fact, the total long-term debt has been continuously going down in line with our strategy to deleverage. It's only the working capital which, of course, due to the reasons which I explained even in my last discussion, that the operational level capacity utilization has gone up from about 71 or 75% to 90% this year. And also because of the price hikes all across, like for all the raw materials, and to a very steep hike, right? So the working capital levels have gone up. But I can tell you that the total amount of the working capital borrowings have remained almost at the same level as we were having in the year 2019, even though we have come a long way from that utilization level to almost about 90% level. So we have been having a strict control on the working capital management and the credit control and efficiently managing, and hopefully they should remain at this level even if we operate at a higher level from now on. So the amount of the debt, and that is why we have said that 45% of the debt reduction which we are targeting for the next 3 years, and this is all scheduled repayment, that will happen and will bring down the overall debt by a large amount going forward.
Right, sir. Last year you did roughly like 900 crores of debt retirement, right, on the overall basis. So, on the overall basis, any targets to have, including working capital limits for next 3 years for the debt numbers?
Your voice is breaking. Can you repeat, please?
Yeah. So, sir, you had a 1,400 crores of debt retirement on the long-term basis, right? So, for the overall debt numbers, any targets over the next 3 years? Which also includes the working capital limits that you have?
So debt target, I can tell you that 1,400 crore piece of the debt, long-term debt reduction which we have targeted for reduction in the next 3 years, from the overall debt of 4,800, assuming the working capital remains at the same level even at the higher level of operations. So 4,800 minus 1,400 will be the total amount of debt by the end of 2025.
Okay, cool, sir. Understood. Thank you so much and wish you all the best.
Thank you.
Thank you.
Thank you. A reminder to the participants, anyone wishing to ask a question, may please press star and 1. The next question is on the line of Mitul Shah from Reliance Securities. Please go ahead.
Thank you for follow-up opportunity. So my question is on the raw material side. Raw material basket as such, how much increase we have witnessed in Q3 over Q2? So how much increase on Q?
We witnessed about 2 to 3% increase in terms of quarter on quarter.
And almost similar amount?
Preceding quarter.
So almost similar amount we have taken price hike, then margin compression seems to be much higher sequentially.
No, we've been able to look from the corresponding quarter, it is a 32% increase, which is on the selling price, it is almost around 22-23%. But we've been only able to pass on 60%. So the delta is still remaining.
Okay. And similarly, how much so far in Q4 increase happened for raw material basket, more or less?
2 to 3%, 2 to 3% expected to increase.
So additional 2-3 Q on Q.
Yes.
Okay. And lastly, sir, in terms of domestic side replacement, which segment do you see revival faster compared to the other segments in this next few months or maybe FY23 beginning?
Yeah, so we see that the revival in the CV segment, in the commercial segment to come back, because the year as a whole there was a lot of muted sentiments in the commercial segment. But as the economy opens up and the COVID tends to go down, and even the OEM is from the CV segment is looking much better. So I think the CV segment will do well. Then in terms of we are still the chip shortage is continuing in the PCR segment, but PCR segment will also do well because the footfalls now to the dealer shops and the buying sentiments will come in place. Similarly, the 2-3-wheeler as well. 2-3-wheeler as well will, to my mind, will be better, because the rural market uptake will happen with the rural spending coming back. And we are waiting for the farm sector, which has been really dull this whole year, to pick up with the good onset of monsoon. And the Kharif procurement, as I told you in my speech, so that should help in getting back somewhat in the farm sector as well.
So in farm sector,
overall, overarching, the economic activity looks buoyant, and this will thrust the overall sentiments in various categories.
So even in farm segments, the replacement side also it was down by 23-24%. So you expect improvement, means it would be lower decline, or it would start reporting growth on the replacement side?
So going forward, that decline will I think come to 0-0 level, and then it will start showing the improvement.
Yeah.
Thank you.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for the closing comments.
Thank you very much once again for participating in the Q3 FY22 earnings call, and I hope we've been able to satisfy the questions being asked, and on behalf of the company, I wish you all a very happy New Year and a prosperous New Year. Thank you once again.
Thank you.
Thank you very much.
Ladies and gentlemen, on behalf of ICICI Securities Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.